Do you think low interest rates guarantee high commercial real estate property values? Think again, because if you're relying solely on interest rates to determine commercial real estate values, you might be overlooking critical factors, and that can lead to costly mistakes. Interest rates don't tell the whole story. They never have. And to prove that, let's rewind to one of the most overlooked but most important chapters in commercial real estate history. Between 1989 and 1992, the Federal Reserve slashed rates from right around 9.75% to just about 3%. That's a massive cut and one of the most aggressive easing cycles in history. And yet, during that same period, commercial real estate values collapsed. So here's what was really going on behind the scenes.
Mr. Chief Justice, Mr. President, Vice President Bush.
During the 80s, commercial real estate development exploded across the U.S. Why? For two big reasons. One, tax incentives, and two, easy credit. The 1981 Economic Recovery Tax Act offered developers generous depreciation schedules and investment tax credits, essentially encouraging them to build fast. And with lenders handing out money left and right, there was little to no restraint. If you had a shovel and a parcel of dirt, you were literally in business. As a result, cities across the U.S. were flooded with new office towers, shopping centers, and speculative projects that assumed demand would just show up. But here's the problem, it didn't. Many markets became dangerously oversupplied. Vacancy rates skyrocketed because there simply weren't enough tenants to fill all this new space. By the late 80s, it was not uncommon to see brand new buildings sitting half empty, with landlords slashing rents just to keep the lights on. So even before the recession hit, the warning signs were already there. The market was built on a house of cards.
When I sign this bill into law, America will have the lowest marginal tax rates and the most modern tax code among major industrialized nations.
The next major blow came from Washington. In an effort to simplify the tax code and eliminate loopholes, Congress passed the Tax Reform Act of 1986, and it hit the real estate world like a wrecking ball. Prior to the reform, real estate was a favorite tool for high-income investors to shelter their earnings. Through accelerated depreciation and passive loss rules, you could invest in a building, take a paper loss, and use that loss to offset your other taxable income, even if the building wasn't making any real profit. But after the act, that all changed. The new rules disallowed passive losses from being used to offset active income, effectively removing one of the biggest incentives for real estate investment at that time. Suddenly, the math no longer worked anymore. Thousands of investors pulled their capital out of the market literally overnight. Syndications collapsed, new projects lost funding, and here's the kicker. All of this happened just as supply was peaking from the overbuilding boom. So think about it this way, you had a flood of new properties hitting the market, and the money that was supposed to absorb them was gone. It was the perfect storm. Oversupply on one side, a massive pullback in demand and capital on the other, and it set the stage for one of the most brutal commercial real estate corrections we've ever seen.
This is USA Tonight with Brad Holbrook.
Good evening. Today is Black Monday, the day the Dow dropped more than 500 points, the day the Dow dropped more than 22%, almost double the rate of the Black Monday that signaled the beginning of the crash of 1929.
If overbuilding and tax reform were the cracks in the foundation, the savings and loan crisis was the earthquake that brought the house down. In the 1980s, savings and loans, also known as thrifts, were small banks designed to make home loans. But after deregulation, they were suddenly allowed to make commercial real estate loans, and invest in riskier assets, many of which they didn't even fully understand. Thousands of savings and loans jumped into the commercial real estate boom, pouring money into office parks, shopping centers, and speculative developments, often with loose underwriting and poor oversight. When the market started to turn, they were overexposed and sitting on mountains of bad debt. By the early 90s, over 1,000 saving and loans had failed. Entire institutions collapsed, and the losses were so massive that the federal government had to step in. That's when they created the Resolution Trust Corporation, or RTC. The RTC's job was simple: clean up the mess. It seized control of failed banks' assets and began liquidating them to recover value. And they did this quickly. What was the result? A flood of distressed properties hit the market. Fire sale pricing. Buildings sold for pennies on the dollar, not because of intrinsic value, but because the government wanted them off their books. Those sales now set the new low comps across the country. Property values weren't just down, they were anchored down by these distressed transactions. And that reset the pricing floor for the entire industry. Investors who bought at market rates literally just a year or two earlier, they found themselves completely underwater, not because of interest rates, but because the entire system had cracked. By the early 90s, the damage wasn't just in pricing, it was in the flow of capital itself. The entire lending environment seized up. Banks, still reeling from the S&L fallout and massive loan losses, shifted into full-blown risk-off mode. Underwriting standards tightened overnight, appraisals were ultra-conservative, loan-to-value ratios dropped, and any hint of risk, automatic decline. And here's the kicker. Even strong borrowers with good track records, they couldn't get financing. So credit-worthy investors who had weathered the storm found themselves stuck. Deals they wanted to acquire, assets they wanted to refi, all dead on arrival. At the same time, regulators were breathing down lenders' necks, pressuring them to reduce exposure to commercial real estate altogether. That created a vicious cycle. No financing meant fewer transactions, fewer comps, and even greater price compression. Meanwhile, existing owners with floating rate debt or upcoming balloon payments, they couldn't refi, even if the property was performing. Default wasn't about income, it was about the inability to roll over debt. It was a classic liquidity crisis. Cash flow on paper did not matter if capital wasn't flowing in the real world. And this is why lower interest rates meant very little at the time, because the capital markets were essentially frozen. In commercial real estate, deals don't happen just because money is cheap. They happen when money is available. And in a credit crunch, even cheap money doesn't move. So here's the big question. If interest rates dropped so aggressively, why didn't they save the market? Because the fundamentals were broken, period. And no amount of cheap debt can fix that. First, there was no confidence. The system was rattled, banks were failing, developers were going bankrupt, investors were literally paralyzed by fear. Second, cap rates stayed high. Why? Because in an unstable market, buyers demand higher returns. Risk premiums went up, even as rates came down. Third, vacancies were everywhere. Buildings were sitting empty, and there's no rental income. And when there's no rental income, the cost of debt is irrelevant. No income means no value. Fourth, the RTC fire sales crushed the market. Distressed assets flooded the system. These weren't comps, they were anchors literally pulling pricing down across the board. And finally, lenders were not lending. Even though rates were low, credit was locked up. If you can't access capital, the interest rate doesn't matter. So the next time someone tells you that low interest rates alone will lift the market, just remember the early 90s. Because it's not just about cost of capital, it's about confidence, credit, and cash flow. So here's the takeaway. In commercial real estate, low interest rates do not automatically mean high property values. In the early 90s, it wasn't about rates. It was about confidence, liquidity, and supply. Cheap debt means nothing if the system's broken. And today's market, we're starting to see some of the same themes resurface, just wrapped in different headlines. I'm Brandon Michaels. I've sold billions in commercial real estate and helped hundreds of owners unlock the true value of their properties. If you want to think like an investor, not just a headline reader, make sure to like, subscribe, and follow for real insights that go beyond the noise.